Welcome to Market Movers. I'm Jim Uriel with Scott Martin.
Hi, Jim.
Okay, so we are days away from another NFP number. Okay, Tuesday we had that kind of crummy ISM number. We're expecting softening data. First of all, we're going to get softening data. Two, how's the Fed going to respond?
Yes, I think both. Far as, yes, kind of crummy being a technical term, I guess, these days, Jim. And I think the softening data is really interesting to me in the sense of what is the Fed going to do in result of that? Because I think so far, the Fed has been able to rest on these laurels of, yes, hot data, weak data, inflationary or not. Now the data, in my opinion, is soft enough to where the Fed needs to act and act quickly.
Okay, but now let's take it back to assets, though. Does a soft number and a more aggressive Fed mean the stocks are fine?
It means they're going to be better than they would be if the Fed didn't. And that's a great comment you made about asset prices, because I think asset prices are screaming for Fed intervention, screaming for more liquidity, which backs up that whole philosophy of weak data and the Fed needing to act.
And I think they're going to get it. Before we dive into our trade discussion, I'd like to point out that these are examples, not recommendations or advice, Scott.
Yes, you're going to get it, Jim. This trade, in fact, this trade example, because of the fact that I believe you in the sense that the Fed is probably going to act, but are they going to act strong enough is the question. And what is the market going to act like going into the Fed meeting? So I have an interesting kind of positioning here to take a maybe more kind of risk-off example as we go into the Fed meeting here, Jim. So specifically looking at buying the week 3 29.25 2900 put spread for about 8.5 ticks in the ES. It risks 425 to make potential 825. It expires on September 18th with the underlying at 2930. Because I have a lot of longs on, I think the market's going to get a little jittery into the Fed meeting and want to protect those longs with its put spread. And the line in the sand, in my opinion, the ES is 2900, where I'm comfortable seeing the market pull back there and seeing this put spread fill out.
That's what I was about to say, is I love your levels. I'm still somewhat of a bull, which won't surprise you, but the levels and the risk reward seems appropriate in this. Down to 2900 is not that far away. It's a nice little protective
I love
trade.
your levels too, Jim.
Thank you very much. I'm looking at it, this will not surprise you, from the bullish side.
Yes.
I'm looking at the micros. Now, if the micros trade, this is one of those stop-in trades we talk about. So the market right now is 29.30. If the market trades 29.35, and I know that's only 5 short ticks away, I think that's a spot to stop in with a long with a target of 29.75. Now that would mean that we are breaking through those old highs, but I do believe if we're going to go up there again, we're probably going to take them out. A target of 29.75 and a stop then placed below at 29.10. It risks 125 to make a potential 200. Thoughts? Wrong direction.
It's the wrong direction, but I do love your levels. I mean, those are key points to keep in mind as you're looking to position yourself bullishly or bearishly in this market, because we're getting that volatility. We're getting defenses and resistance at those levels. So I think those are great numbers to keep in mind.
Here's a big question, philosophically. What if we get a great news on the trade war? How much is the stock up that day? Could it be up 100 handles?
It could be big, and it's definitely something I believe the market's priced in over the summer, and they're slowly pulling that pricing out.
Okay, thank you for joining us on Market Movers. I'm Jim Uriel, where we are helping to make you a better trader.